Hi, everybody. Welcome and thank you for joining us for this self-directed IRA Saturday. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So before we get started, got to give you the disclaimer. Everything that you're about to see here is for your educational purposes only. It's important to understand the role that Quest will play when it comes to your retirement investments. We're really here to offer as many resources and as much education as we can to both our clients and investors. Right? We're also here to facilitate just about every type of transaction that you would want to do within your self-directed IRA. But with that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investments for you. So who are we? For those of you who don't know us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country in all 50 states. We have over 2.7 billion in assets under administration, and we're hoping that number keeps going up. And currently, we have over 100 employees, 34 of which are certified IRA service professionals. What does that mean? Right? That means when you give us a call, obviously, one thing that we pride ourselves on is that you're not going to get an answering machine. You're going to get someone there who's going to pick up the phone and have a conversation with you and be able to answer most of the questions that you have. And if you want to take a really deep dive into some really niche topics, then we have 34 IRA service professionals there on staff with you to take that dive alongside you. And as it stands right now, we have over $400 million in undirected cash sitting in our clients' accounts. That represents opportunity. I say it every single week, but it still rings true. Right? Whether you're an investor who needs capital to make your deal happen, or you're a part of that current Quest pool, this is where the opportunity lies. Right? But before you make any investment at all, education is the key. You have to educate yourselves on the type of investments that are going to be right for you. So utilize us as a resource when it comes to the education. Check out our education center on our website. Check out our YouTube channel where we have hundreds of videos going over every single topic that you can think of when it comes to alternative investing in a self-directed IRA. And if you see something on there, I'm sorry, if you don't see something on there that you wish would be covered, reach out to us. Maybe we find a speaker who focuses on that type of on that subject, and we get them out here. We're always looking to expand the type of education that we can bring to our clients. Right. But once you have that education and you know what direction you want to go to when it comes to your investments, well, the deal's not going to make itself happen, right? So you've got a network. Again, utilize us as a resource when it comes to these networking events, right? Keep joining the classes like you are right now. Come check out our Thursday lunch and learns, our Tuesday classes. All right. Check out our virtual networking happy hour. That's something that's growing, and we're really happy to see it finally starting to take off because it's just meant for networking. Right, you get to meet people, introduce yourself to all kinds of Quest clients across the country. You get to say what you're focusing in and what you're looking for. Right, we're starting to see deals happen because people are just connecting through these virtual networking happy hours. Right, but by far the most common and used social event that we have is our SDIRA social. Right, that's going to be on the first, second, and third Tuesday of every month in Houston, Austin, and Dallas, respectively. So how it works is it starts at 6:30. You come into the office, you get to network, meet people for about 30 minutes, and then we have a speaker come out. It's going to be a different topic every single time. They're going to present for about 45 minutes to an hour, after which we allow for more networking and deal pitching. Right. So if you have that deal that you're looking to spread the word about, right, if you're looking to raise capital, or even if you have capital and you're just looking to lend, check out one of the socials, get in front of our audience, both in person and the people that are viewing online, because you never know who might be watching. All right, so if you have any questions, feel free to reach out to me. Here's all of my contact information. But today, I think we have something that every single time we have someone come and speak about it, I'm excited for it, right? Because I think specifically with this type of investment, this is the most important factor, right? Every single type of investment has its own due diligence. But when it comes to multifamily deals and syndications, it's important to know the exact type of due diligence that you need to do. And so I want to bring out Jack Krupey with JKAM Investments to come present us and tell us how to go about vetting multifamily deals. Jack, you there?
Yes, I am. Can you hear me?
Absolutely. All right, Jack, the floor is yours.
Great. Well, thank you, Zach, so much for having me. It's a real pleasure. I've been a fan of Quest IRA for a long time. I actually just saw Quincy recently on the Investor Addicts cruise a few weeks ago. So it's great to be here. I want to start by just telling my story and how I got into doing doing what we're doing. So I got into real estate right out of college. I thought I was going to be in the IT computer industry, but I graduated during the dot-com crash and bought a book. I was actually coming back from Las Vegas, and I saw the glitz and the glamour, and I was playing like $5 a hand blackjack and scared, and realized I just needed to do something to generate more income and more wealth, and bought one of those paperback books, How to Make $1 Million in Real Estate, and read it cover to cover. Got back to Rochester, New York, where I'd finished university, and called my landlord. And turns out he owned about 20 other houses and was renting to college students in the area. And 3 weeks later, I owned a house, no money down. And then another month later, I bought another one. And from 01 to 08, I really just lived that infomercial dream, buying low money down, fix and flip, and all the traditional real estate that most people get started at. And realized that it's a grind and it's really hard to scale with smaller properties. Fast forward to 2008. And I was fortunate to move down to New York City, and all these hedge funds were buying up non-performing mortgages. And because they needed real estate people, these are all bankers. So they needed people who had done short sales, who had bought foreclosures, who had flipped houses to be on the banking side. So I moved to New York, ended up working at a large private equity fund. And then we merged with a larger PE fund, and we ended up managing $3 billion worth of non-performing mortgages. So it was a crazy, crazy ride. We'd have hundreds of REOs and foreclosures at any given time. And we also did a lot of loan modifications. So everyone, often thinks it was sort of a vulture type thing, but we actually helped a lot of people. And completely different topic on sort of, I know a lot of people at Quest do buy notes and that area of things too. But it was while I was there, and I was not allowed to do anything in the mortgage space myself because I was a partner in this big fund. So I started looking into multifamily syndications. I had done the single family. I knew that, I was already working a lot of hours, and I knew it wasn't really feasible for me to just go and, buy a single family or two family house. And was also, living in New York, where it was super expensive and highly regulated and difficult for evictions. So I was drawn to other markets that I knew were more business friendly. So I started investing just passively myself. I was in a 200-unit apartment building in Savannah, Georgia, through someone I met through networking in New York, and built up some solid passive income, and it was also very tax efficient. And with all of you here, obviously, anyone who's taken the step of having a self-directed IRA, I'm sure you all appreciate the tax efficiencies. So what we're going to cover today is I'm going to talk a little bit. I already gave you the start of our story. I'm going to talk a little bit about what JChem has done and what we've invested in. And then we're going to really dive into how we look at deals, how we vet our operating partners, and talk a little bit about just current trends. Obviously, interest rates have moved a lot, and overall, I also do want to cover the types of deals we tend to like the most, and that focuses on deals that have a heavy value add component. I'm a firm believer that if the business plan is executed properly and you're actually adding value, renovating units, raising rents, that regardless of what happens to interest rates, regardless if there's a recession for a period of time, if you vet deals properly and are in the right opportunity, you should be able to make money in any environment. So I kind of jumped ahead here, but again, I was on Wall Street for many years. I also, for whatever it's worth, I have an MBA. It was a really interesting time. I actually spent a lot of 2019 in Hong Kong while I was on my non-compete, and was in Asia, and really just got to have like a more worldwide view of economics being over there. So it was a great experience, and I'll actually go back in July for the first time since COVID. So we're having our graduation and reunion at the same time, just because Hong Kong's been closed for over 3 years. So when I when I left my private equity fund in New York, and I was going to invest full time into syndicated deals, what I realized is it's very, very difficult to do it yourself. If you're going to try to buy a 100-unit building, you need a number of years of experience, and you really need a team. To get a loan on 100+ unit buildings in general, you need to have someone else on the loan who's a key principal who has previously signed on a loan and operated. So it's really, really tough to do it yourself. And it really lends itself to passive investing. And I realized that I was at a stage in my life and career that we didn't want to compete with these operating partners who are best in class, have a ton of experience. And rather than compete with them, we set up kind of a fund of funds model. So we're not directly operating any of our buildings, but we have a diversified portfolio, and we work with between 15 and 20 different operating partners, and that covers a majority of the markets in the Southeast and Sun Belt. So we've invested in properties in Houston, in Dallas, in Phoenix, in Las Vegas, also heavy in the Southeast, Jacksonville, Florida, Fort Lauderdale, Greenville, South Carolina, Charleston. So each of our operating partners will look at hundreds of deals, and they're doing the deep due diligence, the financial models, the walkthroughs. They may find 2 or 3 deals a year that they like, and they bring those deals to us. And we may pick 1 deal a month that we like, maybe 2. And so we're really getting the pick of the litter, where there's hundreds of deals being vetted, and it gets down to really the top few deals that we like. So, so we've made 36 different allocations. That's across 8,200 doors. We also did an actual fund of funds deal with a $300 million fund that we actually created a feeder fund, and we negotiated special terms for ourselves and our investors to get a better profit split. And that is a group that has another 8,000 doors alone, and we own a few % of the fund. So it's kind of inflates our door count, but it was a very interesting opportunity. We also like self-storage. We're going to talk mostly about multi today, but we are invested in storage deals as well, and those are historically very recession resistant. I often get questions. I think a lot of investors have done lending or have done joint ventures, but I do get a lot of questions on what is the optimal structure, or what is a fair structure for a syndication and a partnership. And what a syndication is just an entity, a special purpose entity. If it's an individual property or a fund, typically it's just an LLC, and it's set up with various share classes where there's the general partner or the manager, and there's limited partners, passive investors in the deals. Now, typically deals are going to have a preferred return. There are some situations where a structure just gets set up where it's just a profit split. And I don't like those deals in general. And I think most larger deals, it's just not market. A majority of deals and anything we've invested in, if you're putting money in passively, you need to be paid a preferred return for your money while it's at work. And that typically means your money is going to be into a deal 3 to 5 years. And the general partner typically, other than maybe a small management fee of 1 or 2%, is typically not getting paid anything until the passive investors have their capital returned plus any preferred return, whether it's a 6% or 8%. And that's typically paid annually. Now, in many multifamily deals, at least over the last few years, the first year to 2 years, there's typically not enough cash flow to pay the full preferred return. So that preferred return will accrue. And it's not uncommon to have an 8% preferred return, but the first year, the cash flow only generates 3 to 4%. So that 3 to 4% gets paid quarterly. However, once the building either refinances or sells, or the cash flows increase. And that typically happens when rents are going up and renovations are happening. As soon as there is sufficient cash flow, that prior preferred return needs to get paid back to investors as well. And once all cash is returned and any accrued preferred return, that is the only time where the general partner should receive a profit split. What I've seen the most common profit split is 70-30, that 70% to limited partners and then 30% of the profits to the general partner. If anyone is familiar with more of the Wall Street hedge fund thing, there was the old scenario of 2 and 20. Syndications are different. If it's not impossible to get an 80-20 split, but because there's a hard preferred return of either 6, 8, or in some cases 10%, I think it's more common in this industry to have the 70-30 split after paying a hard preferred return. Whereas in the hedge fund world, if you just make a profit one year, you take 20% of it. But then if you lose money the next year, there's just no 20% and there's no pref. I want to talk a little bit about preferred equity as well. When structuring deals, there's sometimes multiple share classes for limited partners. In some cases, there's a share class where if a certain investor puts in more than, say, $250,000, they get a higher preferred return or a different profit split. But one of the hidden things which could actually create much higher returns, but it also is a level of risk, is preferred equity. And what preferred equity is set up as is a share class where the investor typically has a fixed return, but they're paid first. So first you have the senior mortgage, which is usually for 65% to 70% of the value of the building. And then typically, the passive investors make up the rest of that equity. However, in some cases, the preferred equity is between the 65 and 80% loan to value, and they have priority of cash flows. So it's almost like having a second mortgage. And so if you're going to invest in a deal, you need to be able to review the entire capital stack and understand where you sit. Now, that preferred equity is in some cases very good for IRA investors because depending on the structure, you don't always need, you don't really need the depreciation. So I've seen some structures where they provide incentives to the self-directed IRA investors to go in as preferred equity because the depreciation then is left for other investors that are investing with after-tax money, where using the K1 losses is way more beneficial. So there could be some interesting opportunities to kind of trade off a little bit of a safer deal just for foregoing the depreciation that you typically can't really use from your retirement account. So I want to run through this in a little more detail as well with a real example. I mentioned earlier that you could have different share classes. So for example, in our fund, anyone who puts in more than $250,000 gets an 8% preferred return instead of a 6% preferred return. And this is written into the operating agreement with different share classes. We have Class A shares, which are the general partner shares, which are owned by us. And then there's Class B and Class C shares, and each share class receives a different preferred return. Capital events are a very important thing to note as well. I mentioned the return of capital. So anytime there is a sale or a refinance, that constitutes a capital event. So the preferred returns are typically paid from rents. However, if there's, say, a cash out refinance and an investor has $100,000 invested, that cash out refinance will actually return a portion of that investor's capital. So if they had $100,000 invested and we refinance and we actually can return $50,000, that money, it's almost like paying back a line of credit. So that money is returned back to the investor, and now the preferred return is only paid on this smaller amount of capital. So $50,000 is returned, there's still $50,000 in use. And so now you're only getting your preferred return on the smaller amount of money because we've paid back some of it. Now, in most cases, there's a future deal or a new opportunity or a new multifamily building to reinvest in. But as far as each individual fund or each individual syndication, the capital is tracked and returned accordingly. And as I mentioned before, the other than a small asset management fee, any general partner should only receive their percentage of profits once all capital plus all preferred returns are accrued, are paid back. I'm going to talk a lot. I'm going to spend a fair amount of time on this slide here. Now that we've kind of went over the high level of the structure of syndications, and some of this may be common sense, but I just want to go through it and can give some real world examples here. Experience is extremely important. Investors who have been through a crash, it's not mandatory, but we do like investors who have been around for a while. Anyone who's been through 2008 and has the scars and experience to prove it, is a great partner to work with. In recent months here, we've had the interest rates move tremendously. So not too many people have been around since the 70s and 80s and kind of been through the last time that interest rates moved up this quickly. But there's no substitute for experience. Track record goes hand in hand with that as well. We look at the entire team and how many buildings they've owned, how many buildings they've taken full cycle, what their operations look like for renovations, and key principles. Unlike single family, the process for the banks to diligence these buildings is extremely. It's a different level. There's many requirements for the key principles, including net worth. So I like to say that in some cases it's easier to do a 100-unit building than a 10-unit building. But as a passive investor, in some cases I think it's safer, and because of the amount of vetting that needs to be done, it's potentially safer to go into a 100 or 200-unit deal that's professionally managed with high net worth partners than to go in with your neighbor to flip a 5 or 10-unit building. I think the smaller deals, in my experience, have a more likelihood of becoming headaches than the large deals. So we have multiple operating partners, and many of them are 10, 20 years in the business, and they have significant skin in the game. It is actually a requirement. If you're going to syndicate a deal and get a loan from Fannie Mae, Freddie Mac, or HUD, they require that the key principals and the general partner side of the deal have their own skin in the game. That is it's mandatory, and sometimes it's 3%, sometimes it's 5%. There is a net worth requirement in general. If you're borrowing $30 million from Fannie Mae, you need to have net worth generally of above $30 million. And typically there's about a 10% liquidity requirement as well. That means cash in the bank, stocks and bonds. So the key principles, one of the key principles at least, needs to have $3 million in the bank or in a brokerage account that's liquid just to qualify to buy a loan. So a lot of requirements, and for those operating partners that are syndicating deals full time, doing a few a year, that have built up these portfolios, it's really a different level of dealing with a professional team. And for me, it's been a great experience, and I've had less headaches with larger deals than I ever had with smaller single 2-family houses. Okay, let's dive in a little bit to the economics of things. Hopefully most of you, hopefully most of you are familiar with with the term cap rate. Just for a quick review, the cap rate is the net operating income of the building divided by the purchase price. So debt, whatever the mortgage is not factored into that calculation. And multifamily cap rates over recent years had really compressed. It was not out of the question to have a cap rate at 4%, on the purchase. And as interest rates have risen, cap rates have expanded, but not nearly as much as the interest rates have went up. And one of the reasons for that, at least on the types of deals that we've focused on, is the value add component. If you have rents that are significantly below market, you have properties that, the units are from 1984 and they've, the prior ownership was just maybe putting a coat of paint on it and re-renting. If there are units where you can raise the rent from $1,000 to $1,400, that's $400 a month times 12, $4,800. Call it $5,000 a year for simplicity. And if you're at a 5% cap rate, you can take the $5,000 and multiply it by 20. You've created $100,000 of value just by renovating a unit and raising the rent. So because of that, most buyers will pay a premium for buildings that have so much upside potential. Buildings that are more stabilized, typically the entry cap rate is going to be a little bit higher, maybe in the 6s. It's not out of the question in some of the Midwest markets to see cap rates of 8, or what used to be a 10 cap was kind of the norm back 10, 20 years ago. But the market has gotten a lot more competitive in recent years. So as far as passive investors go, if you're looking at deals now, ideally it's the cap rate on entry is above 5%. That's, I think, a good target goal, as long as there's a story, as long as there is renovation and there's a business plan to grow the net operating income. Type of debt is very, very important. There's a lot of deals that have fixed rate long-term debt. When I say long-term, other than HUD does have a 35-year amortization product with no balloon payment, but most of the fixed rate debt in multifamily is still 5-year, maybe 7-year or 10-year debt. There is a balloon payment. It's not as big of a concern because most syndications are supposed to be 3 to 5 years anyway. So typically the debt is going to be structured to be in place for the life of the syndication. However, over the last year or two, there are definitely some operators who have gotten into trouble because they've used bridge debt, which, similar to hard money, is variable. The rates were a lot lower. Hard money on residential was 10, 12% in many cases. The bridge loans were floating, and 2 years ago were at 3%. Because it was based off of LIBOR or SOFR plus 2 or 3%, and LIBOR or SOFR was almost zero for a number of years. Now that the rates have went up, there are deals where the interest payment has doubled in the last year, and that's causing some short-term cash flow issues on some deals that are not making distributions. Fortunately, any deals that we got involved in had an interest rate cap. So if you are looking at a deal and they are using bridge debt, definitely inquire on how much is the interest rate cap, how high could the rate go. I feel we're pretty far along in the interest rate cycle at this point, where I think there's less upside risk, or there's less risk of rates going that much higher, and there could be even some potential upside if rates do decline in the next 2 years if the Fed pivots. Where there could be some built-in upside into deals if you're going in with the higher rate and rates actually start declining. Loan to value is obviously important. We're seeing some deals now where they're assuming prior debt, and the loan to value is in the 60-65% range. The highest loan to value I'll typically see is 80%, and I think that's a little harder to find even in this market. I think as as rates have increased, the lenders have gotten a little more conservative as well. So, but it's not uncommon to be in the 60, 65, 70% loan to value range. And, like I mentioned earlier, keep an eye out for preferred equity. Make sure you're clear on who gets paid first. Is there just common equity where everyone gets paid pro rata, or is there anyone that's potentially going to get paid ahead of you in the waterfall for cash flow? I want to go back to cap rates real quick because I talked about the entry cap rate, and I want to talk a little bit about the exit cap rate. So I mentioned that, in today's market, the cap rate is typically around 5% for a heavy value add deal. And when you look at the exit, the cap rate, we're typically using a higher cap rate to be conservative on the exit. So the business plan dictates that units are going to be renovated. We're going to grow the net operating income. And then when it ultimately goes to sell, there's less meat on the bone in most cases because a lot of the renovations have been done. So it's typically going to sell to a longer term buyer, whether it's a family office or potentially an institution that just wants steady cash flow. And so because of that, the cap rate is typically going to be slightly higher. So it's important when you look at the business plan and the model that you look at their assumptions, whether they're selling in 3 or 5 years, and what returns they're projecting and based on what cap rate. We passed on a deal where they were projecting to sell at a 5 cap when they were buying at a 5 cap. And I thought that was too aggressive. So it's not out of the question that cap rates are 6.5% in a few years. If interest rates stay at about 5, typically the cap rate should be 1.5 points higher than what the 10-year treasuries are. So the 10 years at 4 right now. So a 5.5 cap rate on an exit, I think is a reasonable number, especially in markets in the Southeast and Sun Belt that have population growth and a lot of upside, a lot of tailwinds. This is an actual deal. We just pulled this off of one of our reports. But I just wanted to go through the value add strategy and show a real world example. I believe this was a Greenville. That's actually not a picture of the actual building. I think that's a stock photo, but because that's certainly not a large multifamily apartment complex. But rent starting at $656 for a 1-bedroom after a combination of renovating units and in some cases just raising rents to market. We can grow the rents by 10 to 20%. It's not uncommon. There's a deal in Phoenix where rents are up 91% after renovation. And we're seeing that across the board. There's been some articles recently about rents stagnating or rents potentially declining. And we're not seeing that in anything in our portfolio. And I think the reason is we're mostly focused on workforce housing or Class B value add. So where rents are starting to stagnate a bit is on the higher end, the most expensive, the Class A, the ones with the swimming pools and the nice gyms, the garden style 1980s built apartment complexes that there's just such a shortage of affordable and workforce housing that we're seeing continued rent growth both on units that are renovated and also just units that are being turned over. What we'll find is you can only renovate so many units per month, and you don't want to push your occupancy down too low. And in many cases, the lenders have requirements that the building remains 80%, 85% occupied. So what we'll do is a combination of the units that make sense to renovate. We'll renovate or provide a lease renewal offer to a tenant where if they move out, we don't mind because we want to do a renovation. But at the same time, if we can raise rent by 10% and the tenant stays, we'll just wait till the next year and renovate, hold off renovations on that unit until until the appropriate time. On this continued topic of rent growth here, when we're looking at the numbers, it's important to try to determine the trend of the building and what number you're basing the cap rate on. 12 months can be a long time, especially in this era of inflation. So are they looking at the cap rate based on the last 12 months or the last 3 months? And depending on the situation, we will look at both, but the last 3 months is very important to look at what the trends are happening in the building, especially on if the current owner is actually achieving a certain amount of rent already. Then we feel a lot more confident that we'll be able to continue that or even increase that by implementing our renovation plans. So there's a deal we're looking at right now where if you look at the last 12 months, that cap rate is in the low 4s. However, the last 3 months, all of the new lease renewals are up dramatically, and the cap rate is actually above 5 if you look at the last 3 months, and the income is trending up 10 to 20%. So we like deals like that, and we'll give credit for the shorter term, recent income, because it really is a proof of concept. And if the prior seller is doing any renovations as well, and we can see what the new rent is on renovated units, that is a big plus. We will look at the comparables as well, look at other apartment complexes nearby, and really the number one diligence thing that I'd recommend for everyone on a value add deal is really honing in on does the business plan to increase rents check out? Where are the rent comps? Are they the same square footage? Is the other apartment complex right down the street the same? Is it really apples to apples? Is it the same? Is it really a competing complex, or is there something better or nicer about the competition that may make it harder to achieve those rents? But whatever happens with interest rates and the economy, if you get the rent part right, if that part of the business plan comes together, then it takes a lot of the risk out of these deals. Let's talk a little bit about funds versus direct syndications. I've been talking a lot about individual deals, but one of the other options for investors is to go into a fund that has multiple deals. Now, if you've got a 7-figure retirement account and you have enough capital to put, say, 50 grand into 10 different deals, you may be able to get that diversification on your own. However, if you're going to just dip your toe in and it's your first alternative investment or first big multifamily syndication investment, there's a lot of benefit of diversifying across multiple deals. And we do have one ourselves, but there's a number of good fund operators. And what that provides is diversification. There was the deep freeze in Texas a year or two ago. And, if you're only in one deal and all of a sudden the pipes froze and, you might go months without distributions. Obviously hurricanes in Florida, we love Florida, but, it's nice to have some properties outside of Florida. You've got, the Phoenix, Vegas, which are, historically boom bust markets. With that said, I think things are a little different this time around. The economies are a lot more robust, and there's just a lot of good economic tailwinds there. Texas is obviously booming as well. So diversification, is a great factor. It also allows you to do a little bit of dollar cost averaging, just by nature of a fund. Interest rates were moving up, and as the year progressed, we were getting better and better opportunities because we continued to deploy capital as rates moved and as the sellers had to price in the higher cost of debt to operate these buildings. So it's a great inflation hedge as well. I know with the IRA investing, there could be some UBIT concerns here and there, but in an era of high inflation, having smart leverage is, one of the best hedges against inflation, because, when you eventually pay back the loan, it's going to be, on dollars that are essentially a lot cheaper than today's dollars. And, that dollar cost averaging example, we did a case study actually in business school on this. If you put all of your money into the stock market the day before the 1929 crash, it would take 12 years for you to break even. However, if you invested 6 months before and 6 months after each month in equal installments, you would be positive in less than 2 years. So I think for real estate, I think it's very telling as well. And I think people would have had similar results in the, 2007 to 2009 or 2010. If you're consistently buying for 2 or 3 years or consistently investing, just like you would in a stock market, I think it'll provide really solid returns for investors. And as the market interest rates will go up and down, cap rates will expand and compress. But if you're consistently putting capital into solid operators and solid opportunities, over time, I'm confident you should all outperform the stock market. And if anyone, I'm going to finish up here and take some questions, but if anyone is interested, we do have a number of, we have an ebook, have a fair amount of content available. We have a podcast, and love to network. This was mostly focused on diligence, but I am a tax nerd myself. I moved all the way to Puerto Rico to take advantage of some of the tax benefits, and not a CPA, not going to give tax advice exactly, but I love to mastermind and strategize and help people learn about your goals and see if we can help each other accomplish some of our investment goals.
Awesome. Thank you so much, Jack. And so we do have some questions in the chat, and we'll just kind of run through them as we go. And everyone, if you're still there, if you're still watching, make sure you take advantage of the chat. Now's the time to throw in your questions so that Jack and I can address them. So let's go with the first one. Saying once investors receive their capital back, do they continue to receive profit split, or is that the end of their equity stake since they've been paid back?
In general, if you're in the equity share class, as long as it's not pref equity, you continue to get your 70% of the profits until like in a fund structure where there's multiple buildings, you get it until the fund shuts down. So yes, there are situations you'll have all your money back and you're still going to get dividends, monthly or quarterly. And when the final buildings sell, you'll get additional percentages of the profits on all remaining cash flow until everything is sold. Pref equity, in some cases, it's very, if you're, for example, paid earlier because you get preferential cash flow, there are situations where your return is capped. So there are some pref equity deals where it's like you get 12% and you get 12% annually and that's it. But a majority of the syndications and the funds, you're going to get it as long as there's still assets there. You get it, your percentage of the profits until everything is sold.
Awesome. My next question, asking, what do you mean by partners share the narrative?
Partners.
Yeah, I'm not sure exactly what they're referring to. But whoever asks the question, if you can kind of expand on it, we'll circle back to it. All right, next one. Asking, can you share more information about your approach on the first deal, i.e., how you got started with a limited track record?
Sure. So, our fund launched in 2020, and I'd worked on Wall Street before, and I'd managed a lot of money, but this was our first fund itself, and the first time I was able to take on investors through doing a private placement. And, I really leaned into the track record of our partners that we worked with. Even though our fund itself was newer, we were investing in deals where people had 10, 20 years experience, have done 10 or 15 deals. And even now with our fund, we really focus on the deal. And, we have a deal in Houston actually right now. And, if anyone's on our mailing list, we're actually assuming a loan that has a 2.5% interest rate. And it's with a partner that we've already successfully exited prior deals from our funds. So, I'm not the one swinging the hammer on deals. So we really lean into the vetting of the sponsors. And then, as far as my first deal, I was in New York and I knew a gentleman from a lot of the local real estate clubs. So I'd already kind of known him a few years. I've been following his email list for a while. And, as I built up some capital in New York, I, was pretty comfortable and followed along. He, really just took the time to follow along and see what he was doing. And we had a couple calls. I understood the business plan the best I could at the time. Ultimately just dipped my toe in just with my personal funds. This is well before the fund started. And, really just tested deals out personally. There's an art and a science to it. I think, as long as it's not like you need to spend hundreds of hours, because I think what you'll see is a lot of these syndications, they tend to all sort of bucket into pretty similar business plans. You're buying, you're renovating units, you're eventually selling. So just, understanding the structure and just getting yourself familiar with it so that when the right deal comes across or the right fund comes across, you can pull the trigger and feel confident about it. So I'd encourage everyone, even if you're, some time away from maybe making decisions, is, follow along with deals. And the more reps you get in, you'll start, then you start catching things too. Like I caught that cap rate on a deal. I'm like, your numbers only work if you get a 5% cap rate exit. I don't like this deal. So, once you've seen enough of them, things will just pop up where you just know.
Yeah, you'll kind of grab a nugget of information from each one of them, and eventually you've got yourself enough to make your first deal.
Yeah.
So next one asking, do your operating partners provide personal guarantees, or is it non-recourse?
So for us, we're definitely not non-recourse because we're not signing on any of the debt. A majority of these large deals are typically non-recourse. And they require, key principals to sign on the loan. So if you're buying from, if you're buying a $40 million building and getting a $30 million loan from Fannie Mae, they have a number of requirements. And that includes like a certain amount of net worth, a certain amount of operating partner experience. So it's really tough as a newbie to get into the space yourself. Usually what happens is you join a partnership as like a minority partner. You sign on one of the loans with a bunch of people with way more experience than you. And then eventually you could take the step to be the key principal in a deal. So those loans are almost all non-recourse. However, there is a bad boy guarantee. So essentially if you do improper acts or you embezzle money or you do something illegal, they can then go after you. So it's like a limited personal guarantee, but only if you really, are a bad actor. And for us and for any, Quest investors, it's very rare that anyone is going to want you to have any sort of recourse on the debt.
Okay. And so this next one, I'll let you address it first, and I'll add on kind of from our side. Essentially asking, from a 401k perspective, does the preferred equity behave differently to a standard equity investment when thinking about UBIT or UDFI?
I could address part of this. Again, I'm not a tax expert myself. I do know just from prior talks that I've heard John Heyer say this. I know that the solo 401s don't have as many issues as the UBIT, but I think for like the self-directed Roth, there is issues. I think if structured properly, where you're not actually taking as much of the depreciation, I think there's a way to shield it. But again, we don't make those guarantees for our specific fund, and that's a little bit out. I think I'd rather, Zach, I'd like to hear kind of what your take is on that, just because I don't want to give the wrong information.
Yeah. So specifically, like you said, there is a difference when doing the same deal from a solo 401k versus self-directed IRA. That self-directed IRA will run into UDFI absolutely if the debt is, if the if the investment is debt leveraged. But solo 401ks actually have an exemption specifically for UDFI for any assets held for longer than a year and a day, right? So obviously most of these deals being 3 to 5 years, usually the solo 401k is what makes it such an attractive investment within that vehicle, because it has that exemption from UDFI. So it's really unaffected, like the self-directed IRA would be.
Yeah, the one thing I'll say too is a majority of these deals do pass through depreciation. So as from a tax perspective, you're generally going to show a loss anyway. So I've heard recommendations of you file the tax return anyway, just so you actually can bank that depreciation. And then really when any of that comes into play, it's usually in year 5 when the assets are selling.
Exactly.
And if you're making a really solid annual return anyway. In some cases, net, if you're crushing it and making 20-30% annual on a really good deal and you have to pay a little bit of tax, it's probably not the end of the world. But I know that I think there's calculators out there where you can kind of plug some numbers in and see what the liability. I know that someone else, I don't know if you guys have one, but I know there's one that you can do a calculator and say, hey, here's my returns. If I did have UBIT, what does it really cost?
There is, and I call it for the life of me, I cannot remember. But you are right, guys. If you do look for it, you can find UDFI calculators out there. But you're right. As soon as the IRA, which is normally that tax exempt entity, is running into UDFI, it's also opening itself up to deductions, right? So it can use that depreciation against those. You always obviously want to talk to a CPA to make sure you're maximizing it and everything's being filed correctly. But there's definitely solutions. I'll say just from the Quest end, most of these deals, right, most of these syndications will bring on UDFI, and they're still one of, if not the most popular investment we see, right? So, I mean, just to like that, paint the picture as to how this UDFI is usually handled.
Yeah, and just real quick on this too. Obviously, this is mostly retirement account focused, but anyone who is a high earner, or if anyone is a real estate professional. These tax benefits are extremely lucrative. The accelerated depreciation that is passed through, you could do some amazing things. If you have other rental properties, so there's a lot of, for post-tax money, there's a lot of benefits. You can do a whole other hour on that stuff. But we've had deals where we got almost 100 cents on the dollar K1 loss. 100,000 invested would yield a K1 of $100,000 paper loss year 1. So that's super powerful. And, with that said, when the retirement accounts don't need it, we're actually working on some scenarios where we can provide slightly better deals to the IRA investors that don't need the depreciation, because those investors who need the K1 losses will pay a premium for that. And so we may have some deals in the future that have higher preferred returns, or, a safer part of the capital stack to compensate IRA investors for giving up their depreciation to, those that really need it to, save on their taxes.
Oh, nice. Okay, that's an interesting idea. I haven't heard of that before, but I mean, that makes sense, right? All right, so we'll move on to the next one. Say, are the profits at liquidation treated as capital gain?
Yes.
Yeah. So, I mean, it mean, obviously, and how that's going about being taxed is going to depend on how long you held on to it, but.
Yeah, as I said, almost everything is held over a year. We actually had a deal or two that they had offers in less than a year, but they delayed the closing. We had a deal in Phoenix that sold in a year and 2 days. Most operators are very tax conscious themselves, and don't want to deal with a short-term capital gain.
Yeah, exactly. I was about to say that those 2 days I know were absolutely intentional. So let's take a look at the final question here. Saying, what is the range of expected returns over 3 to 5 years, particularly in a more normal interest rate environment? And what returns were multifamily deals generating over 5 years?
Yeah, I think that 15% average annual type of IRR is happened historically, and I think going forward, I think it's still feasible. And with that, though, you're really looking at, say, between 5 and 8% cash flow the first few years, and then the rest of that return to boost the average or boost the IRR, which is the internal rate of return, which is a very common statistic. Usually you make that up. Now, over the last, people who sold in 2021, 2020, there were people making 50%, 40%. It was crazy returns just because of the appreciation, the rent growth, and the cap rates were at really historical lows. So, the lower the cap rate, really the higher the exit value. So I'd say mid-teens overall. We're seeing a return to more cash flow, because there were points, if you were buying in 2020 and 2021, that the first year cash flow would be really low, either 0 or maybe only 1 or 2% the first year, while units were being renovated and rents were growing. But with lower loan to values, and kind of going in knowing the interest rates are higher, I think what we're seeing a little bit more of a return to higher cash flow day one and maybe lower overall IRR, where instead of doing that 20 to 30 IRR in a 2-year flip, it's going to be a 5 to 7 year hold, where you'll double your money but only make like a 15% average annual, just because you're going to hold longer, and less potential upside. Some of these deals just got crazy. We doubled our money in a deal. That was the year and 2-day deal. On paper, it was supposed to be an 18% IRR, and we made a 97% IRR.
Yeah.
But that was a little bit lucky. But we also renovated 45 of 288 units, increased rents significantly. But yeah, I think target mid-teens. And look, there's some other asset classes, like self-storage, mobile home parks. Some of them have a little bit higher current cash flow. Triple net leasing deals, might pay 10% day one, but you're probably only going to average a 12% total return, where most of the money is just coming in your monthly cash flow, and then the upside is limited. Hopefully that answered. I'm kind of all over the place with the but it's a balance of current cash flow and upside, and depending on your kind of your risk tolerance, and really what rates do. If you go in now on a deal and rates actually drop a point because the Fed pivots, there could be some built-in upside on an exit if rates do come back down. And I don't have a crystal ball, but unlike 1980, when rates were at like 10, 12, 16% briefly, the government's debt is 120% of GDP, I think, right now. So I don't know how long the government could afford to have rates stay this high. But it's a different time. I listened to Peter Zeihan recently, and the average baby boomer turned 65. So if the unemployment is a big part of inflation, and the unemployment rate is still very low, even with some of the tech layoffs. So it's the economy is still pretty resilient. There's still a labor shortage, and they may end up just pivoting because we're kind of in a new normal, and it's tough to say, but I think 15% plus annual on a good deal with a good business plan, I think, is attainable, and that's consistently beating the stock market. And those that say you can't beat the stock market, this is more like buying a business. There's plenty of businesses that have 15, 20, 30% profit margins. And I look at these deals as more like it's more of investing in a business than the stock market is, and that's how I think it's feasible to get outsized returns somewhat consistently.
Okay, yeah. So next question, saying, is the self-directed IRA no benefit for depreciation applicable to self-directed Roth also? So I guess I'll start off on this one. So there's really not going to be any difference as far as the ability for the IRA to take advantage of depreciation, whether it's traditional or Roth, right? That's just a tax treatment of the funds that are within the account, and it'll affect taxation or lack thereof when the funds are distributed out. As far as the self-directed investment process for these syndications go, obviously the IRA doesn't have any sort of taxable income year to year, right? So it could be that that there's no way to claim that K1 in the year that it is. But from my understanding, and obviously, Jack, correct me if I'm wrong, is that end of deal, when they do receive the return on that investment, and now they are running into the EDFI, that's the point that they can utilize that depreciation.
I think you said it right. It's as far as I don't have anything to add. I think you hit the nail on the head there.
Good deal. right. So final question before we let you go, Jack, is are there ratio targets that you look for in the numbers presented in a deal? For example, gross monthly income, purchase ratio, gross monthly income to purchase price ratio, expenses to gross income ratio, anything like that?
Yeah, there's definitely a few. I mean, we look at the expense ratio for sure. Those could range. I mean, sometimes it's 45%. Depends on the state. Texas, the property taxes are a bigger component of the income expenses. I mean, it really does depend market to market, but we absolutely will dive into the numbers, and the taxes being a big one too. Is what is the new tax bill going to be? Some states reassess soon after purchase. Some states it's every few years. There are special firms that will do the analysis and give you a really strong estimate of what your tax bill is going to go to. And I've seen deals that ended up underperforming because they did not expect that taxes would go up 30%, and it's just a big part of the net operating income. On the rent growth side, I mean, we are looking at sort of median income for the areas, and really what are the other complexes in the area doing, and are we, it's not out of the question to raise rents 50% in some cases. It's feasible if the market supports it. It's not really part of the question, but demographically, I mean, the reason we're in the Southeast and Sun Belt is areas that have significant population growth, significant shortage of housing. So we do look at some of the just macro level, some things on key markets. So hopefully I answered. It's it's an art and a science. You can very easily go down a rabbit hole of 100 different statistics too. But really honing in on the rent. I think the rent targets on raising rents to a certain level, that is, if there's one thing, I think the first thing on a value add deal is just hone in on that part. If that part doesn't work, then kind of pencils down, move on to a different deal. But if you agree, if you believe the business plan and feel comfortable about the rents, then you go into what type of interest rate, what's the exit strategy? Is it a 3-year hold, a 5-year hold? Who's the property manager? Who's going to do the construction? Do they have a good track record of renovating, 5-10 units a month? Because there's a labor shortage too. So sometimes it's hard to find workers. With that said, if you have a 100-unit, 200-unit apartment building, those are the types of jobs that contractors will line up for, because that's like a steady, that's a steady year-long project, and that's easier to get somebody to show up when you're going to have $1 million to renovate 100 units than try to get someone to show up to do an add-on to your single family house. Yeah.
All right, Jack, that's the final question there. Thank you so much for coming out. I really appreciate it. Guys, have any questions for Jack over at JKM Investments? All this information is right there on the screen. Reach out to him. Get questions geared specifically for your IRA, and when it comes to these types of investments, obviously reach out to Quest. Any one of the IRA specialists can help you out there. We are currently running our promotion. We're still running the promo. We extended it through March. If you open up an account, we'll move in more than $5,000 before tax filing deadline. You get credited $125, so take advantage of that. And Jack, any closing remarks?
No, I just really want to thank everyone for listening. Thank you for having me on the show, and just encourage everyone to reach out with any questions. We love the network. And hopefully I'll see many of you at one of the future in-person Quest events. I'm going to try to get out for the expo this year.
Awesome. Absolutely. Yeah. The next one that we're having is it's going to be over in Dallas, and we're getting the venue and dates finalized pretty soon. So we're definitely looking forward to that one. So thank you again, Jack. Thank you everybody for joining us, and y'all have a good weekend.
Thanks everybody.